What's going on YouTube? This is your boy the BW Trader back again with another valuable video for you. So I have been saying that I will start a forex trading for beginners series for a while now. I finally decided to upload. I'm done with the content. So the part one of this series is going to be basically based on reading price action from Japanese candlesticks. So I'm going to be telling you the 5 most important Japanese candlesticks that you're supposed to know as a forex trader. So this is the beginning of the series. Without any further ado, let us get into the video. Okay, first my presentation here begins with the welcome remarks. Basically, I welcome you to the BW trading community. Thank you for watching. Thank you for constantly watching. Hit that like button if you like the kind of content that I'm dropping. Consider subscribing and share this video to as many people as you can. Comment down below what other type of forex videos you'd like to see. And yeah, so our main aim here is to help guide you in your way to financial liberty through free forex education on YouTube. You will never be asked to pay for anything on the channel. Therefore, the least we expect that, or the least you could do for us is consider subscribing and hitting that thumbs up to keep the BW trading community motivated, to give us a little bit of more of motivation to keep on giving you this free forex content. So consider subscribing, hit that likes button. So what are Japanese candlesticks? That is the most common question. When you begin, you must understand that although there are so many ways to read price action on the forex markets, the most used by retail traders is Japanese candlesticks. So there are many ways of reading price action from the forex market charts. There are many ways of reading forex price data. We have your bar chart, you have your Hikenashi, you have your line chart. So there are many ways that you could see, there are many different charts that you could see when you are reading price action. You could pull up a Euro USD chart with the Hikenashi. You could pull up a USD CHF chart using a bar graph. You could pull up a USD CHF chart using your line chart. But most retail traders prefer using Japanese candlesticks. Why is it that they prefer using Japanese candlesticks? That is the second point. Retail traders tend to choose these candlesticks because they believe it is easier to read price action looking at candlestick formations and their patterns as price approaches areas of influence like support and resistance. So there are different areas of influence or areas of inflection, high value areas, as some may call it, your support and resistance, your supply and demand, your order blocks, whatever you may call them. The areas of influence on the markets, there are psychological levels, the levels that you're going to be looking at, expecting a certain reaction when price reaches those levels. So it is easier to read price data or price action looking at Japanese candlestick formations. So we have different formations on a candlestick, looking at the open of the candlestick, where it closed, the wick, how big is the body, how small is the body, how big is the wicks. So being able to read chart we are able to read a little bit more into price action by understanding the formation of a candlestick and the candlestick patterns that are formed by a certain number of candlesticks, your head and shoulders, your inverse head and shoulders, your double top, your double bottom. So those candlestick patterns tend to make it a little bit easier for us to be able to predict or to anticipate the potential move or the potential next move on a forex pair if you're trading forex currencies, on an index, on a synthetic index if you're trading your volatilities and your boom 500. So that is why a lot of retail traders prefer using Japanese candlesticks. This does not mean that you cannot trade forex without Japanese candlesticks. You can, if you're able to read price action using a line chart, if you're able to read price action using a bar graph or a Heiken Ashi candlestick. Okay. So the next part of this video going on, I'm going to be looking at the 5 most important candlesticks for you to know as a beginner trader. What are the 5 most important? You do not have to learn all the Japanese candlesticks. So this is basically what a lot of mentors are doing for you. So if you have a mentor, he'll be able to show you only the most important candlesticks. He'll be able to basically summarize his whole trading journey and teach you only the important things that you need. So you may consider getting a mentor if you want to, but most of those mentors are kind of sketchy, but that is a topic for another day. So basically what we are going to do is we're going to be looking into the five most Japanese candles, five most important candlesticks that you need to know. Now, this is Japanese candlesticks. I'm not yet talking about candlestick formations and candlestick patterns and the most important candlesticks that you here we're just going to be talking about the candlesticks that you do need to know, the ones that I believe are the most important, the ones that I have learned for the past 2 years, and I've realized that these are the most influential when it comes to price action. Okay, so how to read a candlestick? Basically what we have here, this whole line here is what we call a wick. So I might get that. So this here is what we call a wick. Oh, I did not mean to do that. So let me go down, let me go back. Before we move on to Japanese candlesticks, we need to first understand. So let me go pick a pen and show you this part here, this whole part here. This is what we call a wick, and then this is the candlestick body. So you need to understand that the body is basically formed by the range that price moved along, and this wick is also formed by that. So as you can see, this wick, it means the market opened here, went up, but could not found resistance. It could not close there, therefore it went back down and closed at this area. That is why it created this shadow. It is sometimes called a shadow because it shows you where price recently been. Although the market did not manage to go even higher and close as a bullish candlestick, but it still had a little bit of momentum to try and go up, found some rejections, went all the way down, closed below. So this is how we form a shadow or a wick. So this is the body. The body is basically that the body is simple to read because it is just between the open and close price, and then the body shows you the most important part of price action. As much as a wick is important, yes, the wick shows you that the market is most likely not going to go there. If there's a huge wick to the upside, then that means the market is most likely not to continue up because it tried going there, found resistance, and came all the way back to close down. So that is how you read price action from a candlestick. This is called a wick or a shadow. This is called the candlestick body, and then this is the open line, the open price, and this is the close price. Now the open price and close price determines whether a candlestick is going to be a bullish candlestick or a bearish candlestick. Now if we are having a bullish candlestick, the open price is going to be below the close price because that would mean the market started at a low level and closed above. That means this is bullish, the market went up. If the open price is above and the close is below, that means the market started at a high price, continued down and closed low. So therefore this is a bearish candlestick. So bulls and bears. Bulls mean the market sentiment to go up. Bears, we mean the sells or going to the downside. So the same concept applies this side. That is the wick or the shadow. This is the body of the candlestick. This is also the wick. So this candlestick, this side here, the white candlesticks on my presentation are going to be bullish, and then the black candlestick are going to be showing you bearish sentiment. So let us now move on to the most important Japanese candlesticks that you are supposed to be familiar with. The first most important candlestick that I feel you need to know, this one, it shows you clear momentum. It shows you that there's a little bit more of momentum or volatility on the market. So this is called a Marubozu candlestick. A Marubozu candlestick, you're going to be able to identify it easily because it has one, a very, very big body, a long body like that. As you can see, this is a very long body. So that is how you identify a Marubozu candlestick. It has a long body and sometimes has very, very small wicks. In actuality, the Marubozu candlestick has very small to no wicks at all. Sometimes the Marubozu candlestick, or most of the times when there is a lot of momentum, you're going to find that the Marubozu candlestick does not have a wick at all because it is showing you clear momentum on the market. So this candlestick here, most of the time it shows potential continuations to the upside. If it is a bullish like this and you have a bullish Marubozu, it shows you that the market, the bulls are in control of the market at the current moment. The buyers are in control because you see this huge candlestick. It shows you that most likely the next move would be a continuation to the upside. Now, this does not mean you're going to trade based only on Japanese candlesticks, but you need to be able to read these candlesticks and understand price action from them. So this is what a Marubozu candlestick shows you. It shows you that the market is most likely going to continue to the upside if it is a bullish Marubozu. If we had a bearish Marubozu, it will show you that currently the bears are in control of the market, and the bears have a lot of strength, or they have power over the bulls. Therefore, a bearish Marubozu will be showing you that there's potential continuation for us to continue to the downside, because the bears currently have a lot of power over the bulls. So that is a Marubozu candlestick. You're going to be identifying it with little to no wick. And then the second point for you to identify it with is that it has a very, very excuse me, it has a very, very, very big candlestick body. It has a large candlestick body. Now, you may go to your trading view, your MT4, and identify this level, this kind of Japanese candlesticks. You will see them happen over and over again. And then whenever you have a huge candlestick that has a big body, small wicks, or sometimes no wick at all, you'll realize that the market tends to continue in that direction for a little while. Now let us move on to the next Japanese candlestick. Candlestick number 2. The second candlestick is basically a doji. Now a doji, it shows you a little bit, what it shows you is a little bit more, it is not the same as what a Marubozu candlestick shows you, but a doji basically shows you that the market has become indecisive, or there's a little bit of indecision in the market. Now, it does not necessarily mean it is showing you a reversal opportunity on the market. You cannot trade just because you saw a doji. You cannot take a trade just because you saw a doji. A lot of things go on into influence your entry. You have to have entry criteria, your entry strategy. This is just understanding the basic Forex 101, right? So a doji candlestick, you're going to identify these candlesticks with no body at all. Most of the time they do not have bodies, but at times they may have very, very small bodies looking like a spinning top. So we have your long-legged doji, your dragonfly doji, where you have the open and close very, very close to each other. Very, very small body, but a very long wick. So these candlesticks are made up mostly of a wick. 90% of the candlestick is a wick. It is showing you that the market is potentially going to reverse. There's potential for reversals. But the most important thing that you're supposed to understand is it does not mean you quickly take a counter trade. You have to wait for the market to confirm. So these are dojis. We have your gravestone doji and your 4-price doji. Now this doji is basically what they show you on the market is indecision. How you are going to identify them on the Forex chart or whatever pair you're looking at, you're going to see a candlestick that has a lot of wicks than the body. There's very, very small body, but there is a lot of wick. The market wicks, or it shows you a lot of shadows, because this basically means the market went up there, couldn't continue to the upside, came down, went down, couldn't continue to the downside, and ended up closing very, very close to where it opened. So the market is indecisive. The bulls were first in control. They lost power to the bears. The bears gained control, but still ended up losing power. So it is 50-50. That is why the body closes. So the body basically shows you which one is more powerful. If the body closes as a bearish candlestick where the close is below the price, it means the bears ended up winning the battle. But when you have candlesticks that close exactly at your open price, or very, very close to your open price, it means the market is neutral. Basically, dojis show you that the market is currently neutral. It has not yet decided whether it is going to go up or down. So that is why I say it is showing you indecision on the market. So if you have a clear trend to the upside, and then the market just keeps on showing, the market all of a sudden shows you a doji, it does not mean you just take a push to the downside. It only means the market currently is indecisive on whether it should continue to the upside or retest a little bit before continuing. So you could take a sell and find that the bulls then after a doji took power. So a doji alone does not guarantee that the market is going to change direction, but only shows you that the market is currently indecisive, which is meaning if it was a bullish market, currently the bears are fighting the bulls and they're in a 50-50 chance. Either one can win. We can either have the bulls continuing or the bears having a small little bit of momentum before the bulls then eventually take control of the markets. So you need to understand a little bit more into dojis. That is how dojis work. And then we may move to the next important candlestick that you're supposed to know. The next important candlestick that you are supposed to know as a forex trader is the hammer. These are one of the most important candlesticks because basically they show you potential reversals. This ones show you potential reversals on the markets. The indecision is clearly, you can clearly see indecision on a doji, but on a hammer, if the market goes to the upside, retest and then gives me a hammer, I know for sure the market is most likely going to continue to the upside after this hammer. So the hammer, how you read price action, the market went down, but the bulls are currently in control because it went down with the bears starting in control, but then we pulled all the way back up. That is why the candlestick ends up looking like a hammer. So the hammer is very, very easy. It basically looks like a hammer. It has a long wick to the downside and then a very small body to the upside. Now that long wick to the downside is basically what you call the shadow, and the shadow shows you where price was recently at. And then how we read price action from a hammer is basically, since we have a long wick to the downside, it basically means the market first began with bearish momentum. The bears were in control, but the bulls are currently gaining strength as they were able to push this all the way to the upside. That is what we call a hammer. So we may then move on to the next candlestick. This is how you identify a hammer. It shows you that there's a potential reversal on the markets because you clearly see that there is a change there. The bears are no longer in power. So the hammer most of the time shows you a potential reversal to the upside. So that is what the hammer is. And then we may go to the next important Japanese candlestick. Next important Japanese candlestick that you're supposed to know is the bearish pin bar. Now, the bearish pin bar, it is more or less the opposite of a hammer, but pin bars happen on both. You can have a bullish pin bar and a bearish pin bar. A bearish pin bar. So basically, a pin bar looks a little bit like a hammer. It has a wick and a very small body. That is how you may identify those. With the bearish pin bar, you want to have your support and resistance. If this is your support and this is your resistance, and then you have the markets move slowly towards that, it pins this here with a bearish pin bar, you know for sure the market is most likely going to now change direction and push to your previous support level. So that is how you may look at bearish pin bars. So that is how you incorporate them into your supply and demand, and that is how most traders do that. So when you are having a bullish pin bar, the market is going to the downside to your support area, and then it gives you a pin bar without breaking this support level. Gives you a pin bar like that. The body did not break, but only the wick did. That is why we call it a pin bar. It has pinned the support level. Therefore, most traders at this point will start or begin to take buys to the upside. So that is how you're supposed to understand this bearish and bullish pin bars. Now, this candlesticks, the reason why I like them, because I do not use support and resistance, the reason why I like them so much is because I trade based off of chart patterns like that, right? So when the market gives me a pin bar at this level, whilst we are also in an ascending structure, then I am able to have a little bit more confluence. It adds confluence to my bias that the market is most likely going to continue to the downside. So that is why I like your bearish pin bars and bullish pin bars, because they add a little bit of confluence. So you're going to identify them on the forex chart with a very, very long shadow, a long wick, and small body also, and they tend to happen mostly at areas of influence, your psychological areas, your support and your resistance. So they're going to happen mostly at those areas, and the market is going to pin and then we reverse. So this ones, they are reversal type candlesticks. Now let us see if we do have another one. Okay, basically this one is more like a chart pattern, but I have decided to include it on the important candlesticks to know. This is the bullish candlestick, a bullish and a bearish engulfing. So this ones here, they show you reversals. If the market was going to the downside, and then all of a sudden the previous candlestick, the current candlestick that is formed is more than half of this previous candlestick, then that is what we call a bullish engulfing. If this candlestick here, after all the bears that go to the downside, this is a bearish candlestick, right? Then you have this bullish candlestick. If this bullish candlestick that is formed, this is the current candlestick, and it is bigger than this previous one, it is 2 times this one, then that means you are having a bullish engulfing. And then the bullish engulfing most of the time shows you that there is potential reversal in the market. So if you have the market move down and then you have a bullish engulfing, it shows you that now momentum is most likely to be with the bulls to the upside. That is why we call it a bullish engulfing, because this is a bullish candlestick. It engulfs this bearish one. Therefore, we expect or anticipate that the market might now have changed the direction to now go to the upside. And then for bearish engulfing, you have the market going to the upside. All of a sudden, a red candlestick or a bearish candlestick engulfs the previous candlestick. It is 2 times the previous candlestick, or it is more than half of the previous candlestick. It closes against. It shows you that the market is most likely to now continue to the downside. I'm sorry about the chickens again, because like I've said previously, I basically live in a farm. So that is what you see. So that is a bullish engulfing and a bearish engulfing. That is the end of our slide. So that is the end of our slide. Thank you for watching. I hope that the candlesticks that I just showed you help you with a great deal on understanding a little bit more about price action. This is basically the introduction. I will be releasing such videos each and every Wednesday. Forex trading for beginners will be released each and every Wednesday. 2000 hours GMT plus 2, which is South African time. So I'll be releasing important candlesticks. Forex trading for beginners, this is going to be released this Wednesday. This is being released as you are watching it. It's a Wednesday, so I'm releasing this on a Wednesday. So that means next week Wednesday I'll be releasing part 2 of Forex trading for beginners, which will entail of important chart patterns that you're supposed to know. And then we're first going to look at the important candlestick patterns. That is part 2. Part 3, we are going to be looking at chart patterns that you're supposed to know. We first look at candlestick patterns, that is part 2. Part 3, chart patterns that you're supposed to know, and then we will take it from there to look into technical analysis. Now, how to draw your trend line, how to identify support and resistance levels, how to identify inflection points, how to identify order blocks. All the important concepts that you're supposed to learn about forex trading before you even think of executing a trade. So that is what you're going to be learning. Thank you for watching. Consider subscribing, like, comment, share, subscribe, do all that good stuff. Without any further ado, peace.